The truth is, the Canadian government and the CRA want you to pay more taxes. And over the past few years, taxes in Canada have just been increasing, making it more and more difficult for Canadians to build wealth. But what if I told you there are tax loopholes in Canada where you can literally make over $1 million completely tax-free? Sounds too good to be true? Well, in this video, I'm going to share 3 strategies that you can use to make over $1 million in Canada completely tax-free, legally, of course. Hey, if you're new here, my name is Michael Lee Kim, and I'm a financial coach, CPA, and TEDx speaker. And my goal is to help you learn how to retire young, not old, all while enjoying life. And so the first strategy to make over $1 million in Canada completely tax-free is something that most people know of, but they're often not using it the right way. These days, I feel like most people know that they should be investing their money. So they buy a few ETFs, throw it into an RSP and TFSA, and call it a day. But investing is like a tool, and it doesn't matter if you have the best, fanciest tool if you don't know how to use it. And so if you know how to use investing the right way, you can actually make over $1 million completely tax-free. And there are 3 main strategies to do this. The first strategy is through capital gains. Capital gains is any income that is generated when you sell an investment. For example, let's say Apple is $10,000 and then you sell it for $20,000. You would get a capital gain of $10,000. Now, the key thing is that capital gains is only triggered when you sell an investment. But the thing is, if you never sell, then you're actually never triggering any taxes. And this is a way that you can build a lot of wealth without triggering any taxes. The second investing strategy that you can use is something called eligible dividends. Dividends are essentially cash paid out by a company to shareholders. And there are 2 main types of dividends: eligible dividends and non-eligible dividends. Eligible dividends are essentially any dividends distributed by a publicly traded Canadian company. So think of RBC, TD, etc. While non-eligible dividends are any dividends distributed by non-publicly traded companies. Now, when you receive an eligible dividend, you don't get taxed on the full amount. Instead, you're going to be taxed in 3 main steps. The first step is a 138% gross up. And so let's say you receive a $10,000 dividend. You would gross it up by 138% and add the total amount to your taxable income. Now, although this looks bad, don't worry, it gets better. The second step is that you'll pay taxes on the full gross up amount. And so if your marginal tax rate is, let's say, 40%, you would pay total taxes of $5,500 on your dividends. But here's the key thing. The third step is that you receive a dividend tax credit. And there is a federal and provincial dividend tax credit. And so assuming you're based in Ontario, this would be the total tax refund that you would get, which means you would only have to pay about $2,000 on your $10,000 dividend. Now, because of the unique way that eligible dividends are taxed, you can actually make up to $60,000 to $70,000 of eligible dividends completely tax-free. And I explain this in depth in this video. And so if you want to watch this video, I'll leave a link to it in the description below. The third investing strategy is to use the TFSA. So normally you would have to pay taxes on any investment income generated. But if it's within your TFSA, you don't have to pay any taxes on any investment income. So any capital gains, dividends, or interest generated within your TFSA is going to be completely tax-free. And so depending on your age, the TFSA contribution room limit is about $102,000 as of 2025. And assuming an annual contribution room increase of about $7,000 and an average annual rate of return of about 8%, that means in 20 years, your TFSA will have a total value of over $700,000. And assuming a 5% yield of your TFSA, you would be able to generate over $40,000 of income completely tax-free. Now, if we add the income from your eligible dividends and the income from your TFSA, that's well over $100,000 per year completely tax-free. And over 10 years, that's over $1 million completely tax-free. And so remember that investing is a tool, and the results that you get is based on how you use this tool. And that's the reason why you can't just throw some money in some ETFs or RSP hoping that you're going to make lots of money. You need to have a tailor-made investment strategy and plan. And if you want to learn how to invest your own money so that you can retire early in your 40s and 50s while still enjoying life, then get access to my free early retirement calculator. I'll leave a link to it in the description below. The second strategy to make over $1 million completely tax-free in Canada has actually created the greatest number of millionaires in this country. In Canada, the average home price back in 2000 was around $160,000. And now fast forward today, the average is over $700,000. And in major cities like Toronto and Vancouver, the average is well over $1 million. So imagine you bought a home for $300,000, and today now it's well worth over $1.3 million. That is a $1 million gain. Now, normally you would have to pay taxes on this $1 million capital gain that you have. But there's one big exception called the principal residency exemption. This is where if your property is considered a principal residence, then 100% of the gain is completely tax-free. Okay, but then what actually qualifies as a principal residence? Well, there's three main criteria. The first is ownership. You or your spouse must actually own the property. Number two, it has to be ordinarily inhabited, which means you and your spouse have to actually live in that property. Now, you don't have to live there all year round. You can just live in that property for a certain amount of time in the year. And lastly, you can only have one principal residence per year. If you have multiple properties, they can't all be your principal residence. You can only designate one property per year. Now, though the principal residency exemption is very powerful, you actually might not want to use it all on one property. You see, the formula to calculate a principal residency exemption is equal to the capital gain multiplied by the years designated plus 1 divided by the years owned. Now, the key part of this formula is this plus 1 over here, which essentially means that you get an additional year of exempted capital gains if you designate a property as a principal residence. For example, let's say you owned a house for 10 years and a condo for 10 years. The house you bought for $500,000 and sold it for $1.5 million, while for the condo you bought it at $200,000 and sold it for $700,000. And so this would be your total capital gain. But the thing is, you can only designate one property as a principal residence for each year that you own the property. And so how should we split it? Should we put it all in one property or split it between both properties? Well, let's look at some scenarios. Scenario one is if we use all 10 years of the principal residency exemption for the house. And so if we plug this into the formula, you wouldn't have to pay any taxes on the house, but you would have to pay full taxes on the condo. And so option two, let's say if we do 9 years on the house and 1 year on the condo. Well, in this case, this would be the total gain that you would have to pay. And so as you can see, the most optimal scenario is scenario B, where you get to save an extra $100,000 in taxes because of the additional year that you get by designating at least 1 year of principal residency exemption to the condo. And this is why it's so important for you to learn the rules of the game, aka how taxes work in Canada, because as you can see, this can save you a lot of money. Now, the last strategy to make over $1 million completely tax-free in Canada is something that I honestly couldn't believe actually exists. You see, for the longest time, I actually never wanted to start a business. Growing up, I constantly saw my dad trying to start many businesses and fail. And so all I wanted was to get a stable 9-to-5 job with health benefits until I learned about this strategy in my tax course in university. You see, there's a tax loophole called the capital gains lifetime exemption. This is where if you sell a qualified small business corporation, you can make up to $1 million in capital gains completely tax-free. Yep, I said that right. Over $1 million completely tax-free. Now, there's 3 criteria as a qualified small business corporation. The first is that you have to satisfy the small business corporation test. The corporation must be a CCPC, which means a Canadian-controlled private corporation, where at least 90% of the fair market value has to be used actively in Canada. Number 2, the holding period test. This is where you have to have at least held the shares for 24 months before selling them. And during these 24 months, these shares can't have been held by anyone else other than you or a related person. And lastly, the active business test, where 50% of the business corporation assets must have been used in an active business carried primarily in Canada. And so if your business meets the criteria of a qualified small business corporation, then if you sell your business, you would be able to claim that $1 million completely tax-free. One of my clients actually had an e-commerce business that they built and sold for over $1 million. And so he was able to claim over $1 million completely tax-free that he was now able to use in order to retire early. And so when I learned about this strategy, I was like, oh my gosh, so this is how rich people become rich. It isn't by working a 9-to-5 job where more than 50% of your income can go directly into taxes. It's by using tax loopholes like this, where you can make over $1 million and not pay a dollar. And this is one of the reasons why I'm on track to retire early in my 40s and how I've been able to help hundreds of clients do the same, which is by focusing on more efficient sources of income, where you're able to make and keep more of your money. And when you're able to do this, you're able to achieve your goals 10 times faster with less effort. And so if you want to learn how to retire early in your 40s and 50s while still enjoying life, then apply to work with me in my coaching program, the Early Retirement Fastlane. To learn more and apply, just go to the link in the description below. The truth is, the Canadian financial system doesn't reward those who just put their head down and work hard. The secret to building wealth in Canada is by learning the rules of the game so that you could work smarter, not harder. And if you want to learn about more tax strategies so that you can make and keep more of your hard-earned money, then I created a whole tax playlist on my YouTube channel. And so feel free to watch it right over here.